Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka, and all of us, would be thinking, thank God it's Friday because two key events are out of the way now. The budget that happened last weekend, and today, of course, it was the first, RBI policy from the new governor, and the first one post budget, the first for the year, and he has delivered, right? He's given a 25 basis point rate cut that the market was already anticipating. However, we didn't really see quite a lot of cheer playing out in the market. In fact, we did, see a triple-digit cut coming in on the Nifty. Although towards the end of the session, we managed to recoup most of the losses and in fact ended pretty flat for the day, although in the negative territory. So the Nifty is back near that 23,600 mark. We did dip below that 23,450 mark as well intraday. But thankfully staged a good recovery from there. What disappointed the market was the fact that the stance has been maintained at neutral. The market was hoping for a more accommodative stance from the governor. That didn't come by, and no additional liquidity measures were announced. Although the governor has assured that the RBI will be nimble when it comes to liquidity management, but that kind of got ignored by the market. And most experts are of the view that the rate cut cycle will be a little more shallow than what was being anticipated. So these are some of the factors that came as a disappointment. And on the Nifty Bank index also, we saw this index slipping below that 50,000 mark intraday, but staged a good recovery. Although we ended lower by about 200 points or thereabouts on the Nifty Bank index, but well off the day's low. The Midcap index managed to end the day in the positive zone. Advanced decline ratio, although was tilted towards losers, so 1:2, that was the NSE advanced decline ratio. Banks were under a spot of bother, but you had other rate sensitives like autos, doing well, realty as well gaining today. But metals deserves mention, this sector, because it was shining bright even when the market was falling, and even by the end of the day, it clocked in gains of somewhere around 2.5% to 3% or thereabouts. So yes, metals was one pocket that was shining bright in an otherwise weak market, so to say. You can't really blame banks, for the sell-off today, because there were quite a few other large cap names or heavyweights that were witnessing selling pressure. So on the Nifty, contributors on the downside were the likes of Reliance Industries, HDFC Bank, ICICI Bank, ITC, and SBI. So yes, a lot of other large cap names also contributed to today's losses. In terms of the individual movers on the Nifty, as I mentioned, metals were doing well today. So Tata Steel, JSW Steel, these were, even Hindalco for that matter, were among the gainers. Airtel, after good set of numbers, gaining. Trent also saw a relief rally yesterday. Remember, it tumbled over 8% after numbers. Today, some bit of buying coming in there. M&M also steady quarter and reacting to that among gainers. On the flip side, ONGC, ITC, SBI, Britannia and TCS were among the laggards. From the broader end of the markets, also some gainers, Godfrey Phillips, Bharti Hexacom, Welspun Corp, these are some of the notable movers. On the flip side, you had stocks like NCC and Sonata witnessing a fair bit of selling pressure, double-digit cuts coming in on these stocks. Aside of that, you had BKG as well as Rajesh Exports, those were the other laggards. But I have a guest for the afternoon to talk about where the markets are headed now that two of the key events are out of the way. Joining me is Nirav Karkera, Head of Research at Fisdom. Nirav, great to have you on the show. Let's talk about the policy first. Markets seem to be disappointed with the fact that, stance was left neutral and there were, no additional liquidity measures, so to say, that were announced. What does this really mean for the future rate path? Would you say that the 75 basis point cut that the market was factoring in for this particular cycle may not really come by, and the rate cut trajectory here on still remains uncertain? Because this was being seen as a symbolic rate cut by the RBI.
Yes, so this was perhaps amongst the most awaited events after the budget, and now that it is here, it is only appropriate to discuss a few points about the MPC announcements. Number one is the quantum of rate cut. Of course, the street estimated a very aggressive stance in terms of rate cut to be delivered today. However, this is also incidentally the first full MPC presentation by the new governor. So most segments of the market were anyway on the edge of their seats and looking out for cues on what the current governor's stance is on the larger economic backdrop. So, of course, there were expectations for an aggressive rate cut against the global backdrop of, a series of now aggressive rate cuts already happening around the world. But like you rightly said, 25 bips was taken in as a symbolic rate cut. Of course, there's a whole lot of appreciation, but, the expectations were running really high just before the rate cut was announced. So that really tempered down and bore on heavy on, investor sentiment. So that's one on the quantum side. Second, there were hopes that the stance would shift to a more accommodative one, wherein there would be some indication of acceptance of a much more dovish stance going forward. However, that was completely absent from the address. The stance was maintained, and which indicates a wait and watch and a much more thought through stance rather than a reactive one. So that was second, that sort of ruffled some feathers in terms of investor sentiment. Third, talking about the path going ahead, the former two clearly indicated that the current rate cut cycle isn't going to be as steep and as aggressive as we would have liked it to be at the time. So this could be slightly shallower and run through for much more longer duration. So the pathway has extended. That's one thing that the current MPC address definitely communicated. However, the fourth thing that most market participants were looking forward to were certain tweaks in terms of banking liquidity that has been offered by RBI. But there was very little mention of that. Of course, like you rightly said, the governor did assert that RBI would be nimble and agile to respond to liquidity needs. But as of now, there was, this entire subject was largely absent in the address. So with no definitive sight of, any liquidity operation happening as a part of the MPC decision, we are, the markets largely are slightly soured in terms of sentiments around that as well. But having said that, we have known that the RBI has generally been nimble and agile, especially through the past couple of years now. And it doesn't take for an MPC meet for RBI to intervene and manage the liquidity situation. And one good thing, one silver lining is that the governor did assert its commitment to growth while being highly cognizant about the inflationary targets. Now, considering that we are getting a firmer handle on the inflation and there's a flexible targeting agenda outlay. We believe that the RBI will be much more nimble-footed in its approach, and there is very limited reason to doubt RBI's willingness to arrange for liquidity as and when the need arises. There is no reason to believe this is only going to be an MPC to MPC event.
That said, what's the call on banks now, Nirav? The governor did mention that he's quite happy with the credit deposit ratio. That means the banks can go out and lend more. And there has also been some relief in terms of liquidity coverage ratio implementation. That timeline has been extended. But of course, as we were talking about no liquidity measures being announced, and we know that there's a serious deficit, in the banking system. What does all this mean for, banks from a shareholder point of view? How should one approach banks now?
So, one thing I'd say at the outset is that the immediate reaction of the listed bank pack must not be considered as the entire impact that one can expect, or even largely indicative of the impact that one can expect on banks. Because think of it this way: most measures that have been announced are slightly accretive to banks. Although what we saw in the markets today could be some sort of reversal of higher expectations, but structurally the announcements are positive for the bank. Just before this, I spoke about the banking liquidity needs, and while the sheer absence of this point could have led to a negative outlook for the banks. There is no reason to believe that the RBI won't intervene as and when required. In fact, the governor went out of his way to assert that they will be nimble with it. So that is one thing in favor. Second,
Hmm.
with the credit deposit ratio being in the favorable zone and the credit offtake, the demand scenario being slightly more upbeat, especially in cognizance of the budget as well as the rate cut, we believe that there is a much more stronger case for credit offtake to support banks, if nothing else. In fact, larger banks have already started indicating that they will replicate the rate cuts in their lending portfolio as well. The LCR deferment furthermore, allows certain headroom for banks to continue lending slightly more aggressively to larger ticket projects under the larger umbrella of project finances. So there is some chunky credit offtake that we can expect from there on as well. So, most of these things point towards a structurally accretive backdrop for banks at large. And, this MPC has also largely been, positive for banks.
Hmm. Okay, but that clearly wasn't really reflecting in the market. Perhaps market mange more. That's why we saw the kind of weakness in the market that we saw today. But what about some of these power financiers like PFC, REC? Project financing norms will also get deferred by a year. It has come as a relief for the likes of PFC, REC, right? So also the fact that the stocks have already seen a fair bit of correction. Would you have a positive view on these stocks now?
See, the segments that stocks like PFC, REC operate in are, very core infrastructural segments. Our outlook has remained constructive and optimistic on the larger, infra and utility space, very specifically. Right. So the outlook for the segment at large is optimistic. Second, the pushing of the LCR draft further by a year, and also, the governor sort of indicating that this is also, sort of a difficult timeline, and the governor asserted that they will take all conscious measures to ensure that the transition is smooth and a softer landing is being provisioned for in terms of, whenever the LCR draft actually gets implemented. This sort of a commitment, sorts of give us a lot of comfort in terms of these industries' ability to raise more funds and the funding ecosystem to be slightly more open towards lending to companies like PFC and REC. While these remain solid companies, it is also a fact that they run longer gestation projects with a higher capex requirement, the requirement for which will be needed to be fulfilled through debt fund sources, right? So this entire
Hmm.
situation works in favor for companies like PFC and RFC. So from here on, add it up along with the recent correction in valuation. This definitely warrants a relook at from an optimistic perspective.
Okay, that's the view then. But one pocket that was shining bright today was the metal pack. In a weak market, we saw almost a 2.5 to 3% kind of gains on the Nifty Metal Index, and two of the top gainers on the Nifty were also from the metal pack. Now, Chinese property stocks have been rallying today on reports that the government of Shenzhen has vowed to bring real estate investment back to growth as soon as possible. Uh, but what's the view here, especially after the U.S. tariff hike on China? These moves, would you say that these are just knee-jerk moves, or is there more legs to the metal up move that we keep seeing from time to time?
Definitely, one thing is for sure that there are more legs to the metal up move. So while what we see on an immediate basis could be a knee-jerk reaction to newly imposed tariffs and the Chinese government's response, but what we also see domestically is a much more structural uptick in terms of the business and companies involved in metals as a sector. In fact, to add to it, today's rate cut only furthermore bolstered the case for steel and metal companies. Think about it this way: if the entire rate cut were to be actually transmitted and project financing was to take off, like we discussed, in the earlier response, a key element that is a key, input to infrastructure and longer gestation. mobility projects and logistic projects is going to be metals and very specific steel, right? And a rate cut also ensures that the interest cost for most such balance sheets, irrespective of whether it is highly leveraged or just a little less leveraged, it will see a direct such companies will be a direct benefactor of lower borrowing costs, right? So one can expect inadvertent demand to flow into segments of metal and steel, and this is expected to augur really positively for metal and steel companies on the top line side of the P&L, at least.
Hmm.
Of course, margins remain in the question mark zone as we speak. It really depends from company to company, but largely, at least, we can see some top line expansion, and the entire narrative around credit offtake and larger capex demand by private entities as well as government capex continuing flatlining, though, will continue to contribute to greater top lines for most operating in the metals pack.
Hmm. Sure. Let's now break it down and talk about some stocks. The stock of the week for me, of course, has been Trent. We have Sheen's re-entry into India after a ban of 5 years. The numbers came out yesterday, and they were largely in line with muted expectations. But expectations have run far ahead when it comes to Trent. It was, of course, the showstopper, stock for last year. But is the golden period over for the time being? Given the fact that the stock has seen such a huge run up, would you say that it is time for more valuation correction here on?
See, the growth outlook for Trent has definitely it definitely warrants a moderation, of course, and the management also indicated consolidation of store counts would be a continued affair as they seek to penetrate more micro markets. So this could continue to bear heavy on the bottom line growth. However, it still continues to earnings outlook still continues to be in the green. All right, it is just that the expectations need to be moderated from here on. In fact, one last macro tailwind in favor of trend was this entire consumption-friendly budget that we witnessed last week, right? And the bracket that it addresses the exact TG that Trent as a group is largely after, consumption by this bracket of income earners and this particular ticket size segment, right? So there are macro tailwinds also in
Hmm.
favor of Trent. Of course, valuations have been quite steep, but I believe that there's no reason to completely take it off the table. It must continue to be on your watch list, and every opportunity, every decline or every valuation correction must be reviewed from an opportunistic lens. The outlook still remains favorable for Trent going ahead. However, it has been moderated, but it still remains highly optimistic.
Hmm. Sure. Outlook still remains optimistic on Trent. But another stock I want to draw your attention to is ITC. One of the big drags today. There were no negatives in the budget for ITC. In fact, tax cuts would spur consumption. That was the general view. So it has emerged as a budget winner because there was no cigarette taxation as well, right? And numbers were also quite good. Cigarette volumes also were above expectation. So what's leading to the weakness, and what is the view here on a stock like ITC?
So, ITC is a case where macro tailwinds are largely offset by micro headwinds. I would say the key problem that ITC is facing, or key challenge that ITC is facing, is rising input costs. Across segments of feedstock. Let it be wheat, let it be maida, let it be tobacco leaf. The input prices are really, really rising. In fact, even if you look at the set of numbers. While top line has been growing, it has bottom line hasn't been able to keep pace as much. Even the margins are, seemingly under some pressure. Rising input costs are becoming a challenge. The recently demerged hotel businesses also yet to fully, fully take shape in terms of what was expected of it. On the other hand, you have its paper packaging side of business where it faces stiff competition from exports from the Indonesian and Chinese regions, which is flooding the Indian markets. In fact, even the domestic wood segment, prices in the segment has been exerting a lot of downward pressure on margins for ITC. So I feel input costs and management of costing at this point for ITC is the larger looming challenge. And this is something that has been bearing heavy on ITC and largely offsets most other good news. That comes from the macro side, that is this entire spur in consumption, etc. So I feel this is a business specific challenge that, or rather, even I would go to as much as say an industry specific challenge in certain areas that ITC will have to overcome before it regains investor confidence.
Last question really, Nirav, it's been a double bonanza, right, for consumers in the form of tax cuts and a rate cut as well coming through. Which pockets would you really look at in the wake of these tailwinds? If you talk about consumption, which are the pockets, consumer durables, autos, QSR names, where would you look at when it comes to spotting interesting opportunities now?
So, of course, FMCG is the broader theme, but even within it, if I have to specifically target a segment, it would be consumer durables, like you rightly said. It is in the first order of benefiting. In fact, in automobiles, there is good reason to believe that there will be a faster uptick in the two-wheeler sales, considering the improvement in the rural demand environment, and considering the slightly challenging environment for urban uptake. The case for two-wheeler growth in the two-wheeler segment seems more plausible. Two-wheeler, in fact, also commercial vehicles starts to look better as the outlook for larger capex, seems upbeat at this point in time. Apart from that, a very good hunting ground would be banks at this point in time. We believe there are several banks that offer a very good opportunity, both from a valuation standpoint as well as an earnings growth re-rating standpoint.
Sure, take a note of all the sectors, in fact, pockets that you mentioned, two-wheelers, banks, consumer durables, these are some of the sectors that are going to benefit. With that, Nirav, we've come to the end of the show. Would like to thank you for taking out time this afternoon and joining in. It's been a busy week. We have had two key events to deal with, and tomorrow, of course, we have the Delhi election verdict as well. So, a lot of these cues are out of the way now. We'll have to see how really things pan out here on. Because we did see a good pop after the budget and thereafter a correction. So let's see what the trajectory really looks like. But I would like to thank you for taking out time and joining in this afternoon.
Thank you. Always a pleasure.
Thank you. Well, with that, we are ending the week on a positive note, but a mildly positive note. Nifty has been flat, but clocked in mild gains if you look at the Friday to Friday move. So yes, that's the news from the market, but we are calling it a day then. Thanks a lot for tuning in to watch Closing Bell. Of course, have a great weekend and come back and join us on Monday morning with Opening Bell. But for now, it's a goodbye. Rest it out and have a good one. Thank you.